Welcome back, everyone. Is Warren Buffett's Berkshire Hathaway Class B shares better than an ETF? So here's the big question. Instead of buying ETFs like SPY or Vanguard's VOO based off the S&P 500, is it simply smarter to buy Berkshire Hathaway's Class B shares? Well, over the past 5 years, Berkshire has quietly crushed the S&P 500 and even top ETFs. So in this breakdown, I'll cover who Warren Buffett really is and why insider ownership matters, why Berkshire Hathaway has outperformed the world's favorite ETFs, the companies you can buy alongside Buffett and the ones you can't, Berkshire's fortress-like balance sheet that protects them against missteps, genius plays like the Japanese trading house deals, and ultimately why I am buying Class B shares. So join me as I analyze this interesting company. Now, before I dive into this analysis, I just want to be clear about this. I am not a financial advisor. I'm just sharing with you how I'm investing my own money. So don't just blindly copy what I'm doing. Do your own research, run your own numbers, and decide what works best for you. Then drop your thoughts in the comments below about what I presented. I would love to hear how you're approaching this stock. So let's dive in. First, who is Warren Buffett really? Warren Buffett isn't just Berkshire's CEO and chairman. He owns 14.3% of Berkshire Hathaway stock and controls over 30.3% of its voting power. This is from his 2025 proxy statement filed May 3rd. That's a lot of skin in the game you just don't see with many other companies. And despite being one of the richest men alive, Buffett still earns a modest $100,000 salary. A figure unchanged for over 40 years. Most of his wealth comes not from his salary, but from Berkshire stock appreciation. Now compare that to Wall Street CEOs collecting between 20 to 50 million a year, and you see his confidence is rooted in ownership, not in paychecks. Buffett's track record truly speaks for itself. At just 20, he invested $10,000 in Geico stock in 1951, and sold it for $40,000 to $50,000, but later called the sale one of his biggest blunders. Why? Because if he simply held on to that stake, it would be worth over $1 billion today. In 1962, he bought Berkshire shares at $7.50 a piece. Today, those Class A shares trade for $740,000 a piece. So, if you had invested $1,000 in Berkshire stock back then, you'd now be sitting at around $100 million today. And while Class A shares are out of reach for most people, because they never did class splits, since 1996, they allowed conversions of one Class A share into 1,500 Class B shares. And Class B shares trade for around $490 today. So that puts Buffett's magic within the reach of normal investors like you and me. Now, I'm going to be using Berkshire Hathaway and Warren Buffett interchangeably because he's the CEO and chairman of the company. Next, Berkshire versus ETFs, 5-year returns. Let's get real with the numbers. With Berkshire Hathaway, if you invested $1,000 5 years ago, you'd have about $2,500 today, around a 250% return. The S&P 500 SPY ETF doubled in that same time. Vanguard VOO doubled. Berkshire hasn't just kept up, it has beaten the index funds at their own game. And since 1965, Berkshire's long-term compound annual growth rate sits at around 20%, even with mistakes like the $3.76 billion Kraft Heinz write-down on August 2nd of this year. Berkshire still beat the S&P 500. Its beta score of 0.8 makes it less volatile than the market, meaning stability and growth. Meanwhile, ETFs like VOO and SPY are overloaded with expensive tech stocks. For example, Tesla has a price-to-earnings ratio of 258 and a forward PEO of 222. This makes up 1.61% of VOO because ETF holdings are based off a company's market cap. Or how about Broadcom with a P of 86.48 that makes up 2.5% of VOO, with Broadcom's shares outstanding ballooning from 4.210 million in 2020 to 4.778 million in 2025. And these shares are trading for under $340 a piece. High valuations plus dilution equals a dangerous cocktail. Just look at BlackBerry, once sold for $138 in 2008, is now under $5 and still losing money. Stocks with a price-to-earnings ratio over 25 are generally overvalued unless they are real estate investment trusts. Yet, all over YouTube, you've got influencers hyping these kinds of stocks like they're golden tickets. That's exactly why I'm making these videos. I don't want people falling into the same traps I did early on, chasing hype instead of doing the math. I have been investing in stocks for about a decade, and trust me, I've paid the price for following the wrong voices. That is why I'm more disciplined today. I'm not saying you should dump your entire life savings into Berkshire. Far from it. I believe in diversification and spreading risk across different stocks and sectors in my self-directed registered accounts. But yes, Berkshire Hathaway Class B stocks has earned a spot in my portfolio. So when is the best time to buy Berkshire Hathaway shares? Honestly, that's like asking when is the best time to buy an ETF. There's no crystal ball. It should not be a lump sum investment. That's why I suggest treating it like you would treat an ETF through dollar cost averaging. Got $10,000 you want to put in? Don't put it in all at once. Instead, pace yourself. For example, buy 2 shares a month until you have built up your full position. That way, you smooth out the ups and downs of the market and avoid the stress of trying to time the perfect entry point. Now, for context, most of my registered accounts are heavy in commercial REITs or real estate investment trusts that I bought on the dip, like office buildings, plazas, malls, and warehouses. Land in prime areas always goes up over the long term, so you get equity appreciation, plus REITs usually throw off attractive distributions, collecting rents, which is the REIT's term for dividends. But I also believe in smart diversification, and Berkshire Hathaway Class B is one of the few stocks that fits that bill. Just look at the numbers. Recently, Berkshire stock dipped after writing down $3.76 billion from Kraft Heinz. But here's the kicker. Even with that setback, it still outperformed the S&P 500 and SPY and Vanguard's ETF VOO. And on top of that, Berkshire's beta score is 0.8, meaning it's actually less volatile than the S&P 500. Translation, it gives you growth and stability. So why do I call Berkshire almost a perfect stock for uncertain times? 2 reasons. 1, cash, lots of it. A full 1/3 of their assets are in cash and cash equivalents. 2, opportunity. With that kind of dry powder, Berkshire is always positioned to scoop up bargains during downturns. So when the market panics, Buffett has the war chest to pounce. That's a type of stability and opportunism you just don't get with your average ETFs. Next, I want to talk to you about why you can't out Warren Buffett, Berkshire Hathaway. You simply can't. I've tried it, and take my experience with Paramount as a case study. The setup, Berkshire jumped into Paramount Entertainment in Q1 2022 with a $2.6 billion stake. They were paying roughly $28 to $38.50 a share. And then there was a short squeeze back in 2021 that hit $91 a share, which caught my eye. You never know, maybe lightning strikes twice. So in May 2023, I thought I was clever. I picked up a small position of Class B Paramount shares at $18.88 a share. Way cheaper than Buffett. Easy win, I thought. The problem, Paramount tanked. Buffett started unloading shares in late 2023. Me, I doubled down. I dollar cost averaged my way down to about $12 a share. I held on as long as I did because I saw upside. Exclusive popular franchises like Star Trek, Top Gun 2, and Mission Impossible sequels. Plus, takeover rumors were swirling. The twist? By May 2024, Buffett was done. He sold his entire stake, eating a brutal $1.5 billion loss, and I was left holding the bag. Meanwhile, takeover rumors started surfacing about a $15 a share offer, but the stock was still underwater for another year until a solid tender offer for the Class A Paramount shares went through. So the payoff? August 22nd, 2025, I finally sold at $16.09 a share. Not a home run, but a 30% gain over 2 years. About a 15% annual return. Sounds good, right? Except during those same 2 years, Berkshire shareholders earned closer to 25% a year, averaged over that 5-year period I mentioned earlier. Even with the write-downs. So the lesson? You can't beat Berkshire by cherry-picking their public stocks. And by the way, many of their biggest winners like Geico, BNSF Railroad, Dairy Queen, and Duracell that counteract their losses are companies they took private. You simply can't buy those shares. And that's when it hit me. You cannot beat Berkshire at their own game. Their wins dwarf their losses because they own a fortress of businesses that spins out cash daily and nightly. And they've been compounding this since the 1960s. So what's the bottom line? Well, copying Buffett's stock picks just doesn't work. And by the time you notice what he's buying, it's too late. The market has already priced it in. Recent case in point, United Healthcare. Buffett secretly buys and makes a 12% gain and then news breaks. Retail investors like us, we're stuck holding the breadcrumbs. That's why I stopped trying to outsmart Berkshire. Instead, I joined them. Buying Class B shares means I get a slice of all their best moves. The wins, the losses, the takeovers, and the steady compounding. Another big reason I prefer Berkshire stock is Berkshire has a war chest of cash. As of June 30th, 2025, $344.1 billion in cash, T-bills, and short-term investments, $243.6 billion in U.S. Treasury bills, yielding 5 to 5.3%, and $2 billion in cash equivalents, $3 billion in short-term investments. That's almost 1/3 of their assets sitting basically in cash, giving Buffett firepower to buy bargains if there's an economic downturn. So before I conclude this video, I want to share with you the genius strategic move they made not too long ago called the Samurai Bond Play, involving Berkshire's 5 Japanese trading house investments. Between 2019 and 2020, via their subsidiary National Indemnity, Berkshire bought 8.5 to 9.8% stakes in Itochi, Mitsubishi, Marubeni, and Sumitomo. The acquisition cost was $13.8 billion US. End of 2024, their market value was $23.5 billion. They gained nearly $10 billion from this acquisition. And here's the kicker. 2/3 of this $13.8 billion came from yen-denominated long-term samurai bonds at an ultra-low interest rate, 0.85 to 1.5%. Meanwhile, the Japanese trading houses were paying Berkshire 3% in dividends. The net effect is $812 million in annual dividends. Warren Buffett is 95 years old, and while he remains as sharp as ever, on January 1st, 2026, Greg Abel will step in as CEO of Berkshire Hathaway, with Buffett staying on as chairman. I'm sure Warren will keep an active role as he will still be one of the largest shareholders of Berkshire. So who exactly is Greg Abel? Abel's journey started far from Wall Street, born and raised in Edmonton, Alberta. He graduated in 1984 with a Bachelor of Commerce in Accounting from the University of Alberta. He became a certified public accountant and began his career at PricewaterhouseCoopers, first in Edmonton and later in San Francisco. His real break came in 1992 when he joined Cal Energy, a geothermal energy company. By 1998, Cal Energy had acquired Mid-American Energy Holdings, and Abel quickly rose to become its president. That same year, Berkshire Hathaway took a controlling interest in Mid-American, pulling Abel directly into Berkshire's orbit. And from there, he rose through the ranks in Berkshire Hathaway. In January 2018, Abel was promoted to vice chairman of Berkshire Hathaway, overseeing all non-insurance operations, a massive portfolio including BNSF Railway, manufacturing, retail, utilities, and energy. In this role, Abel wasn't just managing, he was learning Berkshire's unique culture of decentralized leadership, capital allocation, and long-term investing directly under Buffett's watchful eye. In May 2021, Buffett confirmed Abel as his successor, who brings a track record of running complex businesses at Berkshire Hathaway, a temperament built for long-term thinking and the trust of Buffett himself. I'm glad the company did not fall into nepotism, but the best candidate based on merit. If Buffett is the architect of Berkshire's empire, Abel is the builder ready to maintain and expand it for decades to come. Final word. Warren Buffett has been compounding wealth. Even when Berkshire losses like Paramount, its wins massively outweigh them with a fortress balance sheet, undervalued holdings, and Buffett's deal-making genius. Berkshire isn't just good as an ETF. For me, it's better. My philosophy, if you can't beat him, join him. That's why I'm buying Berkshire Hathaway Class B shares. And don't forget, click like and subscribe if you haven't already for more great content, and I will see you in the next video.